Okay.
Welcome, Larry. Larry Kotlikoff, professor of economics at Boston University, good friend of mine. Back to the Glenn Show to talk economics down and dirty. We only have a few minutes
Okay.
this afternoon, Larry, and maybe we can have another conversation.
Sure.
But the subject of the day is the book Capital in the 21st Century by Thomas Piketty, the French economist who's become a rock star of late, up and down the East Coast of the United States on a book tour. Amazon.com sold out of copies, being mentioned in cocktail parties all over the upper east and west sides of New York City and out there in the Beverly Hills confines of the Debris and Chablis set, etc. Now, I'm setting this up because I know you have a lot to say and I want to turn the microphone over to you, but let me just set this up, okay? The book has been critically received within the economics profession. Many people have raised questions about the correctness of the conclusions and the robustness of the analysis that Piketty relies on in his argument about what he thinks will happen to the distribution of wealth in advanced capitalist societies. The book has also been praised by many in high quarters. Paul Krugman, Nobel laureate and columnist at the New York Times, has written in defense of the book vigorously and has praised it. So has Joseph Stiglitz. Robert Solow, yet another Nobel laureate, has written a review in the New Republic relatively favorable to the book. I've seen favorable reviews from Nobel laureate, the guy at Yale, Robert Schiller, from Lawrence Summers has even written a fairly extensive and favorable review of the book. So a lot of people are liking it. But on the other hand, a lot of people are also raising a lot of questions, and you're one of those people. Now I'm turning the microphone over to you, Larry. Tell us what's wrong with the book and how we should be thinking if we were going to get it right.
Well, you can have a Nobel Prize in a lot of things and not know too much about a particular subject. And, so I don't know that Paul...
These guys... okay, I'm sorry. Go ahead. I didn't mean to interrupt you. Go ahead.
Sure. Paul Krugman doesn't know as much about this issue of wealth transmission and inequality as Glenn Loury. Glenn Loury doesn't have a Nobel Prize yet, but he, I think, is on his way. But if I were listening to you about the mathematics in Piketty's book and the quality of what he's saying and the content, it would mean something to me. But when I hear Paul Krugman make statements without ever having worked on the subject, never having written down a model of inequality and the transmission of inequality through time, not observing right off the bat that Piketty's basic theoretical proposition is completely wrong, and it doesn't mean too much. If he says that, or for that matter, if Bob Solow says that, who I deeply respect on lots of issues, but or whoever, I think if you got the math wrong, you got the math wrong. And Piketty's making a claim about the inevitability of wealth inequality getting bigger and bigger through time because the return to capital exceeds the growth rate of capital, which is just garbage in terms of the economics and the mathematics of the transmission of wealth inequality. There's nothing in economic theory that says that R bigger than G, where R is the return to capital and G is the growth rate of the economy, that R larger than G implies ever growing wealth inequality. The reason that he's missing, or the main point that he's missing, and by the way, he's smart enough to know this, and he's worked enough in this area to know this. So I don't think that this mistake was just accidental, to tell you the truth. I think everything in the book is set up to make for a fight between the left and the right here, and to make a sensation. And even the title, which is called Capital in the 21st Century, is a throwback to Marx's Das Kapital. He's trying to pretend he's Marx, but that he's not Marx. But anyway, the basic mistake that he's making here is that people who get inheritances actually consume out of those inheritances. So in the long run, the difference between R and G that people earn on their inheritances is actually being consumed. It's not just being retained. It's the only way that you can get anything remotely resembling what he's talking about is having people that inherit never spend a penny. And then you can get, the Bill Gates's kids and grandkids and great-grandkids, they never spend a penny. The money becomes a huge pile. But if you look actually at Bill Gates, he's giving his money away to the foundation that he set up with his wife. Warren Buffett, who's probably the second richest man in the U.S., doing the same thing, also to the Gates Foundation. So there's an entire set of reasons why wealth does get dispersed through time. We have people marrying, and that certainly divides the wealth right there. They get divorced. They may marry down. They marry, in terms of marrying somebody who's a lot poorer. They may get married many times. They may lose their money on the stock market or in some other gambling endeavor. They may have kids who don't earn very much, and the kids who inherit then have to spend out of the inherited wealth. So there's lots and lots of reasons. And when you simulate this on a computer and you do the hard work that's involved in actually studying this carefully, then you find that wealth inequality certainly does stabilize, as the theory says. So I don't know what to say, Glenn, about Nobel laureates saying this guy's great. I don't know. A lot of people say a lot of things.
Okay.
It doesn't mean that they know much about those particular things.
Okay. First of all this talk about me in the context of Nobel Prizes needs to be completely discounted. Larry, flattery will get you nowhere. Okay.
Listen,
I will say this. I once wrote a paper that had some success. It was published in Econometrica 30 plus years ago. Came out of my dissertation, and it did involve a very careful mathematical model of the intergenerational transmission of wealth inequality. And it did establish, and it was one of the first papers to do this in the economics literature, and many followed suit, that under plausible conditions about preferences in technology and about random shocks, even if you did have passing on within families of wealth one generation to the next, the likely outcome in the long run would be a stable distribution of wealth, not one with ever-growing inequality.
Right. So
I want to get on board with you that the argument in this book, which claims that a disparity in the rate of return to capital relative to the rate of growth of national income necessarily implies an ever skewed and increasing distribution of wealth, with the few at the top holding ever more and more across the generations of society's assets, isn't consistent with the teachings of the standard economic theory models that we write down. And there's no reason to believe that it's true. I agree with that. But I want to say, and I want to get your response to this, I don't think that people like Paul Krugman or Robert Solow or Robert Schiller or, Joseph Stiglitz or Larry Summers, for that matter, who doesn't have a Nobel Prize, but is a very prominent economist, I don't think that their reaction to this book is as positive as it is because they fail to understand this error. In fact, I think some of the reviews, I think of Summers in particular, make many of the points that you just made. Observe that the observed inequality, you didn't make this point, but you will have made it if I'd allowed you, would have made it if I allowed you to talk a little bit further. Observe that the inequality that we're concerned about comes largely from the earnings of labor and not from returns to capital. Observe that the tendency for fortunes to dissipate within families across generations militates against this idea that you're going to get an ever concentrated holding of wealth. Observes that the fact that the return to capital is greater than the growth rate is not an aberration, but is what one would ordinarily expect to come about. And indeed, that the return to capital being less than the growth rate as a permanent equilibrium matter would be a sign of inefficiency in the allocation of society's resources over time and across generations, and so on. So there is a problem with some of the theory in the book, or maybe even with most of the theory. These laws of capitalism.
There's only like
there's
three equations. Two are identities, which he calls laws. And then he's got this other thing, R bigger than G, and he's saying things that just have no theoretical basis. This guy is a fraud. This is just fraudulent economics. This is like cold fusion. And for anybody who knows the literature to read, the introduction, the conclusion, and then the sections that he discusses this quote theory, and not to view this as a fraud just doesn't know what they're talking about. I don't care if it's Paul Krugman or Joe Stiglitz. Now, Joe Stiglitz wrote an article back in the 70s about why inheritance would be equalizing in a context where R is bigger than G. And it's a very there's straightforward reasons why actually having inheritance actually can be equalizing. Suppose that you are...
Hold on, Larry. Hold on. I'm sorry to interrupt, but
sure.
Before you go off on what I know will be an extended thing, I mean, I just want to address this question of these Nobel laureates and very prominent economic scientists liking this book. And I want to push back against this idea that they don't know what they're talking about. And I was trying to say just a moment ago, and I'll say it briefly, this is not the only thing that's in this book, Larry.
Well, let's talk about the other stuff that's in the book. The other stuff in the book is all crap, too. I mean, that's too strong a word. Crap is... I mean, some of the stuff is good. Some of the stuff that he did with Saez on looking at income inequality, that's useful. But,
so the other stuff in the book is not all crap.
Let me just talk for a second here. We're talking about wealth inequality in the U.S., which we know well in terms of the data in the U.S. We know that most of the wealth of lower income people and much of the wealth of middle income people is not in the form of assets, private assets. It's in the form of benefits they're going to get from the government through Social Security and Medicare and Medicaid. And none of that wealth is counted in his calculations. So his proposition that in the U.S. we're seeing increasing wealth inequality is based on looking at half the numbers, or leaving out most of the wealth of the people that are in the lower end of the total wealth distribution, where I call total wealth the sum not just of private wealth, but also of these government claims. And that's been known, Marty Feldstein in 1974 pointed this out, that there's a lot of wealth, and indeed for most people in the country, most of their wealth is really obligations coming from the government, commitments from the government to them that they save for by making contributions to Social Security and Medicare and so forth, and other taxes through their saving years. So to leave that out and then to claim that we've had increasing wealth inequality, and that's your basic data point, that's inappropriate.
It's not his basic data point, Larry. It's not his basic data point. He's got measurements of the distribution of wealth and of asset evolution in a half dozen countries over 2 centuries. Now, whatever the merits of the mid to late 20th century assessment of trends in wealth holdings being well or poorly measured by excluding people's claims on public transfers, that doesn't speak to the question, the substantial empirical achievement that's reflected in this book. There was a lot of work that went into the amassing of the various measures and trends of wealth inequality in these different countries over a long period of time. I'm not saying it's perfect, and I'm not an expert in economic history and so forth, but certainly it's not crap. I mean, what?
No, I'm saying that some of the proposition that we've had, crap is too strong a word.
In any case, I didn't finish what I was trying to say. You say there's nothing else in the book. I'm saying a lot of people, like those Nobel laureates that we were naming, who are not experts on the narrow field of the measurement of the transmission of wealth across generations, but who are experts on the science of economics and how it relates to politics and how it relates to historical interpretation and how it relates to what's going on in the world today, like this book. And one of the reasons I'm trying to say that they like the book is not because they think the 3 little equations and identities that he trots out as laws of capitalism have written a new chapter in economic theory. They like the book because of the audacity of the intellectual project. They like the book because of its link to
this is just really off the chart with you. I mean, look, the fact that the guy, people have been studying wealth inequality for decades. Okay,
you read Bob Solow's review in the New Republic, Larry.
Did a complete review of his numbers, and there's major questions about his use of the data and the sloppiness.
And there are major questions about those questions. Krugman just wrote a full column rebutting the Financial Times rebuttal.
Yeah, and I saw that column, and it doesn't rebut anything. All it says is that this new study that for which there are slides from Emmanuel Saez in Berkeley probably proves what he's trying to claim. You can't write, there's been serious people like Ed Wolf at NYU have been working on the subject for decades. They don't show any increasing inequality. The whole in the U.S. Now, if we go back to he has tried to collect data from other countries and from France in particular over long periods of time, and that's been a project of other French economists, not just by him. And
he and Anthony Atkinson and Saez have put out this whole project going around the world trying to collect and amass this data about assets, looking at tax records and so forth.
I noticed that Anthony.
I mean, it's not nothing. In other words, your dismissiveness, the fact that you're willing to give the whole project the back of your hand. I think it may say more about you, Larry, than it does about the economics profession, whose responses to the book on the whole haven't been nearly as vitriolic.
Well, I think let's take out the emotion here, Glenn. You're getting more emotional than I am. Actually,
okay. I apologize if I offended you. I didn't mean to do that.
Well, the truth of the matter is that the guy has some propositions and some, quote, facts, unquote. The facts are being questioned by the Financial Times. I think people can read that review and come away shaking, scratching their head if the guy can't correctly copy numbers from other studies into his own book. You wonder how
that's a mischaracterization of that problem, Larry. Jesus.
Read the review in the Financial Times, Glenn. That's what it says.
Okay.
And then
I read the review in the Financial Times.
Okay, well, that's what I read in the Financial Times. If the guy can't take into account all the research that economists, starting with Feldstein, 1974, and he was a student at Harvard. He had courses. All the research about Social Security wealth, Medicare wealth, Medicaid wealth. If he can't incorporate that in the book and talk and really do a serious analysis about overall resource inequality, then the wealth numbers aren't particularly compelling. If you're telling me that we should be completely overwhelmed by wealth numbers from the 1700s in France, wealth inequality, I don't know the quality of those data. Okay, I know that the quality of the current data. He can't get the quality of the current data right, let alone the quality of the data back then right. So I do think there's more. The really interesting questions are about labor inequality, because when you simulate on a computer wealth inequality, it's really being driven by labor income inequality. And that has been documented by him and Saez and others. Also people in our government, the Bureau of Labor Statistics. But
okay, Larry, time out. I got to talk for a minute. There's more in this book than what we're talking about, and I want to get to that.
Okay.
And there are issues here about the economics profession being on trial. I like that he tried to write the book that he tried to write. I like that he puts himself in the company of Smith and Ricardo and Marx and so forth. Yeah, because
you're being seduced by all these quotations to Balzac and all that. It's real. This is really.
Well, hold on a minute, Larry. I'm a grown man. I can read for myself. This is not the first book I've read. I haven't been seduced by anything. What I am furious about is the narrowness, the ahistoricity, the sort of siloed disciplinary blinkeredness that has come to occupy my profession. Nobody reads history. Nobody thinks about the grand questions practically. Nobody takes on projects of the sort that are represented in this book. I want more books written like this. I'm tired of finding, my students, cornered into some narrow little cul-de-sac of logical obscurantism and have never read anything. There was a 17th and 18th and the 19th century. The advent of industrial capitalism, the phenomenon, no, I'm not finished. The phenomenon of urbanization, the amassing of political power. So Piketty says you can write down your little neoclassical model where marginal productivities on a smooth production function determine the functional distribution of income. But I want to talk to you about the structure of political economy in societies where landed aristocracy exert one kind of influence under the government, where the wealthy and the modern industrial democracies are able to influence electoral outcomes by their allocation of wealth and by their politicians, where markets are not as perfect as our textbooks tell us that they are. And I want to think in a broadly gauged manner about what that implies about inequality. Even if he doesn't dot all of his I's and cross all of his T's, I think that's the kind of work that people like you and I should be doing. Okay, yeah. I'm done.
Okay, okay. Glenn, with all due respect, I think that's, these propositions that
you're going to take my prize away now, Larry.
What? with all due
I
respect
said,
to
are
you,
you gonna take that prize away from me now?
no, you're going to get the prize because you wrote the best paper on this issue way back when, 30 years ago, in your dissertation. He obviously has never read it. I don't think it's cited in his book, not too much.
No.
And with all due respect, if he's just regurgitating Karl Marx, who had some important insights, great. Why doesn't he just write regurgitation of Karl Marx as the subtitle of his book? And if he's quoting from, we've had people theorizing about social issues, and yeah, it's great to have a book that goes back and quotes from Balzac and so forth. But to me, it's not great to have somebody quote just for the sake of trying to impress other people on his knowledge of Balzac. That to me is not actually advancing any discussion. And then presenting theory that's crap, that has no connection to actual theory, and then having numbers that where you actually know something about the numbers, where the numbers actually are crap too. So on the issue of wealth inequality. So the real questions are not the rich versus the poor. It's not the capitalists versus the capitalists who save everything and the workers who consume everything. That's old-time 1950s Cambridge, England economics that he gloomed onto because he knew that would start another fight like we had back in the 1950s between economists on the left and economists on the right. He just recreated a fight, I think, in order to sell books. But the real issue is not the capitalists, the rich versus the capitalists versus the people with no wealth. The real question is rich workers, high-earning workers versus low-earning workers. The real fight is between workers and workers. It's not between capitalists and peasants, okay? That's not really what's going on today. The real problems that are going on today with wage inequality, which is the foundation of wealth inequality, is the fact that we have lots of things going on, at least in our country, lots of major factors, which I don't know that he discussed. Maybe he did, maybe I missed it, but we've got smart machines taking over people's jobs in ways that technological change did not generate in the past.
Yeah.
We have...
That's something I've been discussing with people here at the Glenn Show, Andy Weiss, our friend, for example, and others. Yeah. And I agree with you that the issues of inequality have a lot more to do with high wage earners and whatnot than they have to do with, coupon clippers. Right. But Larry, I got to go to my next appointment now. I'm late, and I'm letting you have the last word on the thing.
Okay,
and,
let me just say, Glenn,
we'll have to pick this up.
Your long dissertation about people not doing, large-scale, serious stuff. When you spend a year trying to simulate, putting together all the key elements on how wage inequality translates into wealth inequality over time and whether it matches up with the data, that's just an example of a project I worked on. You spend a year with a research assistant, you deal with every major issue of assortative mating and uncertainty of how many kids you have and uncertainty of death, all the factors, the big factors that affect wealth inequality. And you show that you can actually explain the degree of wealth inequality and exactly where it's coming from. And then to hear you say, well, because that study doesn't quote Balzac, it's not good economics or it's not meaningful economics.
That's not what I said, Larry.
I'm sorry, Glenn. That's not where things are. We have a serious profession.
But that's not what I said.
It's doing serious work. We have people looking at big questions. And this is not the first guy to look at big questions. What he's done is looked at a big question in a very, very poor way. He's failed to actually analyze anything big here. All he's done is made mistakes.
Okay, and all of these guys like me who like this book having read it and who felt satisfied that what does Solow say in his interview? This is a serious piece of work. We're encountering a serious intellectual dealing with important questions. We're all just confused because we haven't read your...
I think you're taken in by this guy. I think you're seriously taken in by this guy. I don't think this is a serious piece of work. I do not think it's a serious piece of work.
We got your opinion on the record. Thank you very much, Laurence Kotlikoff, and we'll talk more, I'm sure.
Anytime. Thanks. Bye-bye.
Bye.